Hi, today I'm going to talk about Plug Power. Let's start with the history of the company. In 1997, Plug Power was founded as a joint venture between DTE Energy and Mechanical Technology. Only 2 years later, in 1999, the company went public on the Nasdaq under the ticker PLUG. Afterward, Plug Power grew through multiple acquisitions, and in 2017, the company shipped its first ProGen fuel cell engine, officially entering the hydrogen-powered logistics market. In 2021, South Korea's SK Group invested $1.5 billion to acquire a 10% stake in Plug Power. Their goal was to form a US-Korea joint venture and expand into the Asian hydrogen fuel cell market. Plug Power aims to build an integrated hydrogen energy ecosystem, covering production, storage, transport, and fuel cell power generation. The current CEO is Andy Marsh. He studied electrical engineering and completed his MBA. He has led Plug Power as CEO since 2008. He is now 69 years old. However, on October 7, 2025, Plug Power announced that Andy Marsh would be succeeded by Jose Luis Crespo. Crespo has immediately assumed the role of company president and will officially become CEO in March 2026. The incoming CEO, Jose Luis Crespo, holds a master's in telecommunications engineering from the Polytechnic University of Madrid and completed an MBA at the University of Phoenix. He spent 13 years at Bell Labs starting in 1993, followed by 5 years at Power Distribution handling sales operations. He joined Plug Power in 2014 and most recently served as Chief Revenue Officer. He is 55 years old. Plug Power operates an end-to-end hydrogen ecosystem, producing, storing, transporting, and using hydrogen to generate electricity. First, let's talk about hydrogen production. Plug Power signs power purchase agreements with renewable energy producers such as hydro, wind, and solar providers. The electricity is then fed into electrolyzers that split water into hydrogen and oxygen through electrolysis. Among the different electrolysis methods, Plug Power uses PEM, or proton exchange membrane technology, which offers high hydrogen productivity but comes with higher capital costs. This renewable hydrogen is known as green hydrogen, distinguishing it from gray or blue hydrogen, depending on carbon emissions during production. Since hydrogen is initially produced as a gas, it must be liquefied for easier storage and transportation. In the liquefaction process, gaseous hydrogen enters the liquefier. It goes through pre-cooling and then multi-stage cooling. And once the temperature drops to minus 253 degrees, hydrogen turns into a liquid and is stored in a cryogenic tanks. The liquid hydrogen is then transported to refueling stations or logistics centers using specialized cryogenic trailers. Next step is dispensing hydrogen. At each refueling site, hydrogen is stored, pressurized, and cooled for optimal conditions before being supplied to fuel cells or vehicles. Final step is using hydrogen to make energy. In a fuel cell, hydrogen molecules are split at the anode into protons and electrons. Electrons flow through an external circuit, generating electricity, while protons combine with oxygen at the cathode to produce water, the only byproduct. Plug Power specializes in PEMFC, or proton exchange membrane fuel cells, known for their low operating temperature and fast response, ideal for mobility applications. Their fuel cell modules power forklifts and automated guided vehicles. Fuel cells can also be used in delivery vans, medium to heavy trucks, and even backup power systems for data centers and telecom towers. Major customers include Amazon, Walmart, and Home Depot, along with new contracts from DHL, BMW, and Mercedes-Benz. Plug Power's revenue structure is based on 4 main pillars. First, equipment and infrastructure sales. Fuel cells for forklifts and stationary power, hydrogen refueling stations, electrolyzers, liquefaction systems, cryogenic storage, and transport equipment. This is currently Plug Power's largest revenue segment. Second, Service and maintenance. It includes GenCare, a service program offering scheduled maintenance and remote monitoring. Third, power purchase agreements. Plug Power generates electricity using its own fuel cells and sells it directly to customers. Fourth, hydrogen supply and related equipment. Sales of hydrogen produced by Plug Power and associated delivery equipment. Over the past year, Plug Power's stock price has risen about 40%, currently trading at $3. However, the 5-year return remains minus 80%, and its market cap is around $3.4 billion. Over the past decade, revenue grew steadily until 2023, but has since declined, while the company continues to record operating losses. As of August 2025, Plug Power had 1.15 billion shares outstanding, reflecting continued equity dilution. In March 2025, it raised $280 million through a share offering, issuing up to 180 million new shares, including warrants. Institutional investors hold about 40% of Plug Power's float. As of June filings, the largest shareholder is the Norwegian bank, with 7.67% ownership. CEO Andy Marsh and incoming CEO Jose Crespo each hold less than 1% of shares. Meanwhile, SK Group's stake has decreased from 10% to 4.8%. Now let's talk about 2025 second quarter earnings. First, Plug Power reaffirmed its Quantum Leap restructuring plan, focusing on workforce reduction and capital efficiency, saving up to $150 to $200 million annually. Streamlining production sites, improving service margins, expanding hydrogen production and electrolyzer business, tightening cash management. Through this restructuring plan, they maintain target of positive EBITDA by 2026. This is the income statement for second quarter. Total revenue came in at $170 million, marking a 21% increase year over year. Among Plug Power's various business segments, hydrogen infrastructure equipment and electrolyzer sales were the main drivers of growth. In particular, electrolyzer revenue reached $45 million, more than tripling compared to the same period last year, a very impressive result. The company still posted a gross loss of over $50 million, but that figure improved by 61% year over year. Operating loss came to $180 million, a 28% improvement from the prior year. And finally, net loss was $230 million, 13% better than the same quarter last year. This is the balance sheet for first half of 2025. Total assets amounted to $3.35 billion, of which current assets were $1.33 billion. Total liabilities came to $1.59 billion, including $840 million in current liabilities. Shareholders' equity stood at $1.68 billion. The current ratio was 159% and the debt ratio was 95%. Although the debt ratio isn't ideal, it has improved by about 9% compared to 6 months ago. This is the cash flow statement for the first half of 2025. Operating cash flow was negative $300 million. Investing cash flow was negative $90 million. It is notable that the total cash outflow from operating and investing activities decreased by 40% compared to last year. Financing cash flow was positive $230 million. Overall, net cash flow for the first half was negative $160 million, and cash equivalents at the end of the period stood at $880 million. Lastly, I thought about some investment highlights and risks. The first investment point is the diverse applications of hydrogen. Hydrogen has several advantages. It has a high energy density, it can store excess electricity, and also regenerate power when needed. It also aligns perfectly with the global trend toward low carbon and eco-friendly energy. Accordingly, the use of hydrogen fuel cells is expected to expand across multiple fields, including drones, robots, eVTOL, and AI data center power systems. Because Plug Power controls the entire hydrogen value chain, from production and transportation to storage and utilization, it is an indispensable player in the hydrogen economy. The second investment point is the company's profitability guidance. According to the March announcement, Plug Power stated that it aims to achieve gross profit break-even by the end of 2025. In the Q2 2025 earnings report, the company further announced its goal to achieve EBITDA break-even by the end of 2026. It also set targets to reach operating profit break-even in 2027 and net profit break-even in 2028. Plug Power has never achieved profitability in nearly 30 years since its founding. If the company succeeds in meeting this guidance, there is a strong possibility that its stock price could rise further. Now let's consider the investment risks. The first risk is that under the current Trump administration, it'll be difficult for hydrogen and other clean energy industries to thrive. Trump has consistently referred to clean energy support policies as a scam, both in the past and in the present. Let's take a quick look at what he said.
On things having to do with the Green New Scam, it's a scam. And that's caused tremendous inflationary pressures in addition to the cost of energy.
In the 2026 fiscal year budget proposal, there is a section stating the intention to end the Green New Scam. This means the administration plans to abolish the Green New Deal related budget established under the Biden administration and shift back toward expanding fossil fuel-based energy production. In early October 2025, the U.S. Department of Energy announced the cancellation of $7.5 billion in clean energy subsidies that were initiated under the Biden administration. As a result of this decision, Plug Power is expected to lose approximately $75 million in government support. Meanwhile, nuclear power and SMR-related stocks have surged, at least doubling, and in some cases, rising more than tenfold over the past year, thanks to Trump's strong backing of the sector. For Plug Power to benefit from policy-driven tailwinds again, it may need to wait until at least next year's midterm elections or possibly the next US presidential election. The second investment risk is that Plug Power's attempt to control the entire hydrogen value chain could actually backfire. Plug Power operates across the full spectrum of green hydrogen. At first glance, this sounds impressive, but in other words, it also means the company's business is spread too thin, and profitability is low relative to its R&D spending. By contrast, another hydrogen company, Bloom Energy, focuses specifically on SOFC, or solid oxide fuel cell technology, providing direct power supply solutions to data centers, and its stock price has risen more than tenfold within a year. This shows that not all hydrogen companies are struggling just because the Trump administration is skeptical of clean energy. Plug Power may need to focus on what it does best and on areas where global demand is truly growing. In that sense, as stated in its most recent earnings release, Plug Power's strategy to concentrate on hydrogen production and electrolyzer development seems like a smart move. And this concludes my analysis of Plug Power. Will the age of hydrogen truly arrive? I'd love to hear your thoughts in the comments below. If you found this video helpful, please subscribe and hit the like button. It really helps. Thank you for watching, and I hope you have a powerful day.